Hey there, we are live. It's 4:30. Well, it's a little past 4:30, but who's counting, right? We're getting started just now. I'm Mitch Goldberg. You're watching my live stream. Be the boss of your money. It's a live stream. Do this every day, 4:30. Post-market show about the stock market, what's happening in the world of investments, personal finance. We get into things like insurance, mortgage rates, estate planning, the things that you really need to know to take control of your money, of the financial part of your life, because it's such a big part of your life that when you have that under control, it's amazing how you could focus on other and more joyous parts of your life. I personally don't find a lot of joy uh, in in just focusing on the financial part of my life. I take joy in knowing that, I take joy in knowing that I have it set up, that I have things set where I want, and I monitor. But I want to do other things in my life. Some people just they just want to pay attention to their finances all day. All they could think about is money. Every topic is anything you buy. Do you have any friends like this? Like anything you buy, I have a friend who's like, "Oh, you could have gotten it cheaper here. Oh, I could have gotten it cheaper there." Everything is always about money, and I have to tell you, mark this down, okay? Um, People who are cheap know the price of everything, but know the value of nothing. Think about that. We've got a good show today. I was hoping for a bit of a bounce back. It looked like the market was going to move into positive territory. We did get some stability today, no doubt, after yesterday's hit. It was definitely a more stable day. We'll go through all the numbers in a moment. Things were down today very modestly compared to yesterday. Yesterday was the worst day in the major averages in about 2 years. Uh, okay. So today things are off a little bit. I don't want just an automatic snapback. I know that sounds funny. Aren't you a financial advisor? Shouldn't you be rooting for the market? No, no, no. It's not the way it works. I don't want a snapback where the Dow just rockets 500 or 1,000 points or 1,500 points in one day, because those giant rallies just get repealed within a day or two, sometimes sooner. I want the market I want the market to build slowly, steadily on a solid foundation, uh, so that any gains it has are durable. Now, just so you know, from where we were 2 years ago to where we are now, we're still in pretty good shape. It's the Johnny come latelys who are really in the slaughterhouse right now with the stock market. The people who got enthusiastic about stocks 6 months ago, a year ago, 2 years ago, those are the people who are really in the doghouse. And it's not just with like the pandemic stocks, the Zooms, the Teledocs, the Pelotons. It's with some of the big stocks too. Like Amazon is just basically given up its post-pandemic gain, which, if you think about it, is really just unbelievable. But they're getting squeezed so hard by inflation. The thing that Amazon has going for it is Amazon Web Services, but it's tough to say if that is good enough. Okay. So, anyway, we're going to talk about a couple of things, the ideas that you have, an idea of what's happening in the market, and understanding in the economy, about the economy. These are the things that help prevent you from making hasty decisions, feel good decisions that we know will make you feel bad over the long term, even though they feel good now. And we want you to do things right. So, we'll talk about all of those things. So let's just roll a quick intro, and here we go. And we're back. Thank you so much for joining me. We're just getting started. I'm Mitch Goldberg. You're watching my post-market live stream, Be the Boss of Your Money, which is about taking control of your money. While you're watching, give us a thumbs up, a heart, an applause, whatever reaction available to you in social media. That would help more people see the show, spread the good word, and get the algorithms kicking in, and I get to see who's out there. I see you, Rianne. Thank you so much for joining me. Shout out to you. And you joined me the other day too. I saw. I really appreciate that. And to all of you who are just watching and you're a little shy, you don't have the like button, that's okay. I'm glad you're there. But listen, if you're up to it, if you have a question about the subject matter today of what we're talking about, or something to do with finance or personal finance, you are welcome to ask me about that in the questions. In fact, I love hearing from you. Answering your questions in the comments is the best part of doing this. And if you have some words of wisdom, words of encouragement, you just want to say hi, I love that too. So go ahead, don't be shy. I don't know how it's Thursday already, but the Thursday shows are a little bit quicker. So let's go to the numbers. The Dow down 236 points. Listen, under 1% down day by today's standard, that's a winning day right now. Okay, that's how bad it's been. But I think the Dow's down like 7 weeks in a row now. It looks to be down this week. I don't know if this will be the 7th or 8th week down, but what's the difference? 7 or 8 weeks down. It's just consistently down. NASDAQ down a little bit, down 0.25%. S&P down 23 points. No great shakes. Gold up a little bit. Oil bounced back from yesterday's hit. 10-year Treasury down to 283. So the 10-year Treasury is coming down. What does that mean? We'll talk about that. And the VIX. Let's take a look at the VIX, okay? This is really, I talk about this every day, the VIX, VIX. Okay. The VIX is the volatility gauge. It's basically measures options buying on the part of institutional investors. And when they are worried about the market, they buy certain kinds of derivative contracts to protect their portfolios. Or if they have a very bearish view, they want to buy put options and be positioned for the market to go down. They could be wrong, of course, but it's just a short-term gauge. Its usefulness is very, very short-term, and it could change in a dime. So the VIX, just checking, is 29. There was about 35 at one point yesterday. But you would think after yesterday's hit, it would be like at 40 or 50. And the VIX is now 29. And why did it go down today? What happens usually is when the stock market goes down, like today, the VIX would go up. But the VIX went down. And a lot of people are trying to figure this out. So maybe professional investors aren't that worried about the market going down. It could be that a recession is factored into stock prices. I said yesterday that by the time it's official, that we are in a recession, it's announced, it'll be time for the market to go back up. Now, some people today are saying, oh, if we go into a recession, we're taking our numbers much, much lower. I beg to differ. Typically, once you're officially into a recession and it's known, the stock market's already positioned to come out of it. Now, I'm not saying it can't go a little bit lower. I know somebody will say, oh, well, it went lower after you said that. It could go lower. But generally speaking, let's be longer term than a day or a week. That marks a bottom or thereabout. And I think that's what's going to happen now. The question is, when do we go into a recession? I think we started it. I can't guarantee it, but recessions aren't called until after the fact. Now, so here's the knock that I hear. The consumer is strong. Yeah, the consumer's strong. The consumer has a strong balance sheet. The consumer has a job. The consumer has all that stimulus money. That could change very quickly. Jobless claims have been on the rise the last couple of weeks. There's some hiring freezes from some big companies. Cisco Systems, the big networking gear tech company, had an awful quarter, and they lowered guidance going forward. Walmart, Target, major employers, they're having issues with in particular with inflation. I could see these things turning on a dime. In 1999, the economy was great. Early 2000, even, the economy was in great shape. And by the time we got to March of 2000, things turned on a dime, just went south. 2006 and through the middle to end of 2007, the economy was pretty good. And then we went into the Great Recession. So when we flip from a decent economy to a weak economy, it's not like a long drawn out affair. It does happen pretty quickly. So just because people think, oh, we're in a strong economy, the consumer's in great shape, so we can't go into a recession, that doesn't mean diddly to me. It means nothing. All I could see is conditions that are tightening in terms of credit, of borrowing. Mortgage rates are higher. They're like 5.4%, versus like a little over 3% at the beginning of the year. It's really hard to find an optimistic scenario. I kind of, not kind of, I hate using the word I kind of, or I, I just feel like you kind of, no, I, we are so close to seeing we're so close to seeing the S&P 500 index touch bear market status. Now you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. So if the S&P 500 drops from its peak down 20%, which is not far from where we are now, it would be about 38.55. We're at like 3,900 or so we're exactly 3,900 on the close of the S&P 500. Okay, then we are officially in a bear market. But there are so many stocks down 50% or more, 70% or more. For all intents and purposes, we're in a bear market and we're in a recession, I think. If we do get officially 20% from the peak to where we are now, it doesn't mean that's the bottom. You see things like the average bear market goes down 26%. It lasts 8 or 7 months or something like that. But they're all different. Don't go by averages. Averages are there to make you feel better when things are really bad. Well, the averages only says we're only going to be down this much. Doesn't really matter. Okay, so what the hell were we talking about? Listen, it's been a long day. So I'm wearing my suit and tie today. I had a wonderful event today at Huika Castle for ACLD. That's the agency that supports my son Jordan. Jordan lives in one of their group homes. And this morning I was in the village of Huntington. I met with Caroline Flynn, journalist with News 12, and we talked about the market and a few things like that. And it's been a good overall day. Anyway, we're talking about the VIX is what we were talking about. The VIX is under 30, and the VIX is telling you there's not a whole hell of a lot of worry about the stock market going down much more. And yet, that's all we could talk about is are we at the end of the rally, or I'm sorry, are we at the end of this downdraft in the market? Only time will tell. People always ask me, are we at the bottom yet? Like, how am I supposed to know? All I could tell you is I have my emergency fund set aside. I have cash that I'm going to need in the next year or so, financial obligations set aside. And the rest of it, I invested. And I invested according to my time horizon, my risk tolerance, and my financial goals. Your time horizon to your financial goals is what dictates your risk tolerance. Further away your goal is, the more risk you can take. Not too much risk. If you take too much risk, it doesn't mean you're going to get extra return. Too much risk means you're going to lose. And I see that happening with a lot of investors, people like who are in individual stocks, like the pandemic stocks. Okay, so anyway, that's a big deal. The VIX is confounding people. Why is it down? Let's take a look at the bond market. Yields were down pretty much across the board. The 10-year yield down to 2.844. Now it's 2.842%. So let's just call it 2.84%. And the 2-year 2.6. So yields are coming down. Yeah, I know the 3-month T-bill was up. It's just a fraction, but it's pretty much inconsequential when all the other bonds in the yield curve yields were down. So bonds were up a little bit. So there is a reach to buy some safety, and I think that's what people are doing. I also think a lot of investors may be hedging their portfolios, which is why the VIX is holding up okay. So instead of selling stocks, maybe you'll just buy protection with options. The other thing is it could be the VIX is telling us that the market has run its course. It's gone down enough, and we're going to not go into a recession. There's so much uncertainty. You have to pick a direction. I'm in the camp that go by your personal finance. If you're really suffering in this economy, things are not good for you financially, job market is not good for you, or you're not making enough money from your job right now, then you, my friend, you are in a recession. It doesn't mean the next person's in a recession. It's a very individualized thing these days. Let's keep going. Let's take a look at crypto. Crypto. Crypto had a decent rally. Bitcoin's back above 30,000, as goes Bitcoin, as goes everything else in the crypto complex. Bitcoin was up today. Let's see. The Dogecoin 9 cents. That was started as a joke. I made a big fuss because Elon Musk touted the hell out of it and people bought it at like 70, 75 cents, and now it's 9 cents. So be careful who you listen to. Just because a billionaire says to do something, it doesn't mean it's good for you. And I think when Elon Musk could probably say, well, these people are adults and they could buy it or not. It's not my fault they bought it and went down. I don't really buy that. I think when you're in a position of power and respect, you really need to be careful about what you say and choose your words more carefully. The SEC certainly agrees with that, which is why I think he was fined and maybe kicked off Twitter for a little while by the SEC. Not that Twitter kicked him off, but the SEC said no more tweets. Now he's back at it. Existing home sales fell in April to the lowest level since the start of the pandemic. Home sales are going down, not prices. Prices are up like 14% year over year. There's just a shortage of houses. And now that interest rates are going up, the houses that are available are more expensive to buy. Does the housing market roll over? Here's my opinion on the housing market. I don't think we get a gigantic drop in the housing market. Can we give back a year of gains, a year and a half worth of gains? That would actually be a lot. That would be a 15% plus drop in the price of houses. But the price of houses on the aggregate nationally, they're up like 40% in the last 2 years. So if they backslid, 10 or 15%, not the end of the world. But I know there's still a shortage of housing stocks and building materials. And we have a demographic of millennials and Gen Zers now who are buying homes. And there's just not enough of them. So I see the supply-demand restraint supporting the price of houses. That's just the way I see it. Okay. So that's about it. I think we covered everything that I want to cover for today. Thursdays are usually a little bit shorter of a show. There's not much to add to what's going on except for the things we spoke about yesterday. People are still shell-shocked about Walmart and Target. Cisco took it on the chin. There's just no place to hide. Consumer staple stocks have been getting hit hard. So what do? We be patient. We wait. This too shall pass. Thanks so much. I will see you Monday. I will live stream tomorrow. If something really crazy happens in the market, then I'll definitely do a live stream tomorrow. And that has been the case a few weeks of the last month or so. But hopefully tomorrow is a quieter day and we could relax for a change. Okay? Take care and thank you very much.